Hey, what's going on, everybody? It is Hammer coming to you this week. It is July 5th, 2023. Joined by this week's guest, Christopher Thomas. Christopher, thanks for joining us, man.
Thanks for having me. Glad to be on.
So, do us a favor, tell everybody a little bit about yourself.
I'm Chris Thomas. I'm from Grosse Pointe, Michigan, in the Detroit area. I've been in Veta VA for probably about like 4 to 5 years now, and it's been awesome working with everybody. I have a passion for understanding the VA guidelines and getting as many veterans in the house as possible.
Very good. Well, thank you for joining us today. Appreciate having you here. Remember, y'all, if you guys have any questions or comments, please feel free to go ahead and post them if you are on YouTube or on Facebook. If you're here live, take a minute and let us know. I do see that we have a few of you on. I see some Veta VA professionals. You guys can chime in as well and say hello. A lot of times, see who you are, unless you're permitted to show you. So let me know your name so I know who's on today and all that good stuff. If you're watching on the replay, I know many of our VA consumers will watch on the replay. Do us a favor, just give us hashtag replay in the comments. Let us know that you were watching. And of course, if you have any questions, if we weren't on live and you have some questions about anything we talked about, go ahead and post them in the comments. Feel free to tag myself or to tag Christopher, and we will be glad to answer those for you. So without much further ado, let's go ahead and dive in. Christopher, we're going to give them all some rate information and kind of tell them everything that's going on here. So remember, as we talk rates, y'all, remember this is not an offer to lend. When we talk rates, we're talking about averages and generalities. But for your unique situation, you always want to shop around and want to make sure you're working with somebody that you're comfortable with. And of course, I always strongly suggest you check out some of our vetted professionals here in the VA communities. With that said, let's talk a little bit about rates and a quick recap. So rates started to creep higher last week, y'all. I told you that may happen as markets prepare for the Fed to continue raising the Fed's policy rate, which is called the Fed funds rate. Now, the Fed does not set mortgage rates, but when the Fed is raising their policy rate, it's kind of like that saying that all tides, that the tides lift all boats. And it's the same kind of a thing. When the Fed raises their policy rate, it's going to push all of the rates across the markets higher. Mortgage rates, car loan rates, credit card rates, all of those rates moving higher when we see the Fed raising rates. And what you'll see, we've talked about on many, many occasions, is that mortgage rates will actually react before the Fed makes any actual rate adjustments. So right now, we are anticipating the Fed will raise rates in July. That's almost a month. It's about 3.5 weeks away, the July meeting. I think it's July 26th. And yet markets are already reflecting as if the Fed had raised rates at that meeting. So we see mortgage rates react early, and that's why we've started to see markets react to the idea that the Fed will raise rates. So VA rates now generally in the high sixes into the sevens, depending on your credit score. Christopher, what other elements might affect the interest rate quoted to our veterans?
The credit score, the zip code, and the loan amount.
Okay, so those are all things that can affect your rate. That's why you want to shop around. But generally, rates in the high sixes to low sevens. Does that sound right to you for VA rates today?
Yeah, that sounds right. And conventional sounds spot on with like a touch above 7. That's kind of where they've been hanging out as of late.
Yep. So that's kind of where we're seeing. So if you're getting rate quotes in that area, you can rest assured that you are seeing something that's normal. In fact, I saw a post on the Facebook page the other day where someone was surprised by the rate quote that they had received from their lender. They'd been working on obtaining property for quite a while and were getting ready to lock in, and rates were higher than they anticipated. So if y'all are ever curious about what direction rates are going, that's why we do the show for you each week. So this week, there's a few different events that are going to affect interest rates. And I want to kind of talk about each of those and let y'all know exactly what is happening and why they're affecting rates and what you may expect from that. So basically, we've got what's called the JOLTS data. JOLTS stands for Job Openings and Labor Turnover Survey. It's a BLS survey. BLS stands for the Bureau of Labor Statistics. So the Bureau of Labor Statistics putting out a survey about jobs that were created or labor turnover. And if this data, which is actually going to come out tomorrow morning, if it shows that the job market is still strong, then that's going to be bad for mortgage rates, because although it sounds It sounds pretty mean, but mortgage rates improve when people lose their jobs. When the job market starts to suffer, when the labor market gets a little bit softer, that's when mortgage rates tend to settle down because of the way the economics work. When people are not making money or when they're afraid they're going to lose their job, people spend less money. Spending less money helps to slow the economy down. And that's why mortgage rates tend to get a little bit improved or lower when that scenario happens. So when traders get this data and they say, oh my goodness, the labor market's doing very well, what that means is that points to the fact that the Fed is likely to continue raising rates this year. And as the Fed raises rates, mortgage rates go up. We've seen 10 rate increases over the last 15 months. And that's why we've seen mortgage rates that went from the threes to the sevens. So the other data we're going to get tomorrow, we're going to get ADP. They're a payroll company, one of the largest payroll companies in the US, and they're going to release their report showing about new payroll data. Basically, if there's been new jobs created or if payroll is increased. So again, job market strength going to be bad for mortgage rates. One of the reasons I do not anticipate seeing rates go down anytime soon. And then the last one is the big report. And that is the Bureau of Labor Statistics, the BLS. That's their non-farm payroll data. So they're talking about, hey, what jobs are created according to the Bureau of Labor Statistics that are non-farm jobs, of course, meaning that they have nothing to do with farming. And but the regular jobs, in all the different sectors, if we see strength in the job market, in this labor market, that's going to give an open door for the Fed to continue to raise interest rates, because the Fed needs to kind of slow the job market down and slow the economy down if they're going to get inflation in check. And inflation's still a problem. So that's why we're seeing that. And you'll see some reports. You guys can, anybody that's watching, you can follow these reports. You'll see them on Yahoo Finance or Bloomberg or Reuters or, a lot of, even CNBC, a lot of different sources that are going to talk about this data over the next couple of days. And especially on Friday when we get that non-farm payroll data and they say the number of jobs created. If it's a large number of jobs created, that's going to be bad for mortgage rates. If we see wages that are increasing, well, that means people have more money to spend, and that's going to be bad for mortgage rates. And unemployment, that number went up a little bit at the last month's report. If that goes down, that also a little bit bad for mortgage rates. So that's what you want to keep an eye on this week. And as we've said, the forecast for interest rates and what we anticipate happening from here, rates are not likely to drop much from here, y'all. If you are out house hunting, you want to be comfortable with the idea that the payments that you're being quoted right now, that's likely to be your payment for a while. We've anticipated about this time this year that rates would start to fall and that the economy would be seeing a recession. And all of that forecast has been wrong. Absolutely wrong. And that's why, just like trying to forecast a hurricane, well, it doesn't always go the way you forecast it. So what we do need to realize is that in the current environment, rates are not likely to drop much from here. The Fed, in fact, is expected to raise rates again right now at the July meeting, and then we're likely to see another rate hike sometime this year. The Fed has been very clear that they think there's going to be at least 2 more rate hikes. We have 4 more meetings. We have a meeting in July. We have a meeting in September. We have a meeting in November and a meeting in December. And you can see those on these tabs right here. And this is what we call Fed futures, where we can see what the markets are pricing in right now. Right now, markets expect that we're going to see a Fed rate hike in July. This here says that we think we're going to see a Fed rate of 5.25%. So the Fed rate currently 5%. We think it's going to be 5.25% at July. That meeting again is July 26th. Right now, markets believe that in September, that it will still be at 5.25. It's about a 75% probability. Markets believe that the Fed will pause rates like they did in June and not hike anything. Now, there is about a 20% expectation that we'll see another rate hike in September. Now, if you look at this tool in this graph, if we see markets and traders start to anticipate this column goes up and this column goes down, and instead of staying at 5.25, but we think the Fed is going to raise rates a second time in September, as markets prepare for the idea that that's going to happen, we'll see mortgage rates react now, and mortgage rates would actually creep higher. We want to keep a strong eye on this. And by November, markets believe about a 30% expectation the Fed will raise rates again, only about a 55% expectation that they would stay with one hike in July. And by the end of the year, markets currently pricing in that the Fed will actually be at 5.25%, and about 27% believe will be at 5.5%, and some believe we may have to start cutting rates by then. And this is very unlikely, but markets are preparing for it. So this could be a little bit confusing, but really, again, just the bottom line about this part is the idea of, hey, is the Fed going to raise rates from here, and how many times will they do that? Mortgage rates not likely to go down anytime soon unless we start to see some really strong data that shows that the economy is cooling off, and that the labor market also cooling off. So, Christopher, I've been speaking for quite a bit there. Do you have any questions, or do you think our veterans might have any questions about any of the things that I talked about there?
I think that the way you laid it out makes sense about positive jobs would lead to an increase in rates, correct?
Yep. Positive jobs would lead, exactly. So I think that's very much so. Let's talk about what kind of an effect that's having on consumers today and in your market, in that Detroit market. A lot of people think because mortgage rates are up higher that housing prices have come down quite a bit. Have you seen that in your market?
I actually haven't seen that in the Metro Detroit market, Grand Rapids market, a lot of the markets that I'm in the weeds in with my agents. A lot of homes are still going over asking. There's not as much room for veterans to get those concessions for no cost out of pocket type loans, which we can use. The VA has great tools to do that. So, yeah, what I'm educating my veterans on is be comfortable with your payment right now, right? Be prepared for that payment. The VA Earl is on the horizon. We don't know when you can take advantage of it, but it is a great way to get in the door now and refinance later. But don't be sold an empty promise by a loan officer that you'll be able to refinance in 6 months, a year from now. We don't exactly know when rates will come down or significantly benefit your particular scenario.
Yep. And for those that may not be familiar with that term, EARL, it stands for Interest Rate Reduction Refinance Loan. One of the advantages of being a veteran and using a VA mortgage is that it's an expedited refinance process. So it goes much quicker and it has less requirements to it. They do have some unique requirements from the VA that are protect you as the veteran, to make sure that you're not being taken advantage of by lenders for commissions, honestly. And some of those requirements, Christopher, what do they look like?
So you have to wait from when you purchase the home. You have to wait about 6 months or 210 days until you can refinance. So that prevents what's called churning, of being sold a 7.5 interest rate and then drop down to 7.25 like a couple months later and keep churning you, which leads to another point where you have to drop your interest rate by at least 0.5% and recover all of the costs within a certain amount of period, called the right to recoup.
Yeah. So it is wonderful if you're buying a home today and you say, hey, I'm kind of concerned. Rates are a little bit on the higher side. What if rates go down? And again, if rates do go down, and it may be a when, but it's an if rates do go down and you have been in the loan for 200, you've 210 days from your payment, and you're going to save more than 0.5%, you can very easily get into that rapid refinance loan, and that will help you to lower your payment. So you will have options. So always keep that in mind. Do you think that now is a good time for somebody to buy a house, and why, Christopher?
I do think it's a good time to buy a home because I just see with the higher interest rates, it's an opportunity. If you can qualify and you can make things work, it's an opportunity to beat out competition right now. Whereas when interest rates drop in the future, home prices could continually increase with more buyers entering the market. So even though the competition is hot right now, it could be even hotter in the future. So if you can afford to get in, if you can afford to manage this interest rate and bend but not break, you might be rewarded later with some more home equity as prices increase, and you might be rewarded later with a lower interest rate through the VA Earl program. So I do think it is still a good time to buy. And a lot of times housing is a need for veterans, right? You're relocating or you're buying your first home. So sometimes it's just an essential means to an end to buy a home and make that investment as long as you're going to be there for a little bit.
Right. That makes a lot of sense. What about people that are concerned we're in a housing bubble? Do you think we're in a housing bubble?
I do not think that we're in a housing bubble based on all the research and readings I've done, and I've been paying attention to that question as well because it is a hot question because 2009 is still fresh in our minds. I was a senior in high school at that time. I was in my own bubble. I was heading off to Michigan State. I wasn't concerned about worldly events, and that's a privileged position to have that outlook. But I'm paying attention to that to educate my clients as well. I do not think that we're in a bubble.
Yeah, and for those of you looking for some backup reasons on why we're not in a housing bubble, it has to do with inventory and the fact that inventory is still extremely tight. In order to actually have prices drop, what happens is you have prices go down when people are competing to sell their property. That means an overage of inventory. When there's more people trying to sell than there are people trying to buy, well, one of the ways that you sell a home is you lower the price. That's going to make it a hotter buy. That's going to help you to, sell it before your neighbor. And that happens when there is an inventory glut, when there's more homes for sale than there are people looking to buy homes. But we are very, very firmly in the opposite position right now. Even with rates being higher, there is still extremely strong demand for all of the homes. And I'm in the North Carolina market. In my market, Christopher, a friend of my wife's, they put her mother's home on the market I think it was maybe Monday, right before the holiday, even, right? And on Monday, before the 4th of July, they put it on the market at 10 a.m. They already had an offer by the afternoon. They had a bunch of people looking at it all through the day. And the offer was for $65,000 above the asking price. And it was just, home in the I think it was in the mid threes, and it was 65,000 above the asking price. One offer, not even a full bidding war yet, but just one offer because they know what the market is like there in that Asheville, Western North Carolina market. And we see that all over the US. You said you're seeing that in the Metro Detroit, Grand Rapids, and those different markets as well.
Correct. And something I'm actually encountering too is uh, when appraisals are going out on these over asking properties, we have to be very conscious of what we're going to do if the appraisal doesn't come in,
Mm-hmm.
or how to gap the appraisal. And if we have inventory that we have comparable data, because I'm seeing a lot of properties come in with comps that are from September of last year, December of last year. So I'm hoping that the comparables catch up so we have less appraisal gap situations and homes are priced appropriately. That's one thing that I'm seeing. Um, and Hammer, I had a question. Are you seeing stuff like that? So if you said it was your mother-in-law's home?
Well, yeah, friend of my wife's, her mother. Yeah.
Okay, friend of a friend's home, $65,000 over asking. When you're talking to your buyers, how are you handling that conversation with over asking, bridging those funds with appraisal, and
Oh,
how are
well,
you
I mean, it really does. Like you said, it depends on the market and who is buying. So for a veteran, one of the advantages of getting a VA loan and putting no money down is you may have money available that if you do need to bridge that gap, that you can bridge that gap. So let's explain to everybody first what happens if their home does under appraise. Let's say they want to buy the house and they've made an offer of 350 and the house comes in at 330 and there's a $20,000 gap. Christopher, just explain to everybody what happens in that scenario when the purchase price agreed upon is 350, but the appraisal comes in and says the home is worth 320.
350 and 320. So we have a $30,000 gap.
Yep.
So the VA, you have in most scenarios, right, depending on eligibility, but you have 100% financing on the 320. You are responsible for closing costs and the $30,000 appraisal gap.
Okay.
Your first thing that you're going to want to do is Tidewater would be invoked in this case where the appraiser is letting you know the appraisal is gonna come short. They're not gonna let you know the value right away, but you're gonna get with your real estate agent. You're gonna come up with comparable sales and get back with the appraiser to try and get the value up and justify it, which would limit the amount of gap as much as you can get it close to the 350 purchase price as possible.
So let's take a minute, and that's you used a term that many people aren't familiar with, and you said Tidewater. It almost sounds like something out of a Jason Bourne movie where there's a, it's Project Tidewater. What does Tidewater mean when it comes to a VA appraisal?
So Tidewater means that your home is not going to appraise for the value based on that individual appraiser's opinion, comparables, research. So the appraisal's coming short, like you said in
Right.
your
So
example.
it's gonna come in at a lower value. And then you said go back to the real estate agent. Why would you want to involve the real estate agent?
So the listing agent, we're all working as a team to get the loan done. In my opinion, we're all working as a team, whether it's a buying agent, listing agent, title agents, we're all pushing to get this loan closed. So the listing agent would have listed that property for a reason at that purchase price. Maybe
Right.
they have comparable data. Maybe they have a pulse on the market of what percentage is going over asking. So they could be a good resource to go to. But your buyer's agent is also your advocate, right? So they may have some comparables to help you provide comps to the realtor.
Right.
The other thing is your buyer's agent being an advocate is they could advocate to negotiate and maybe meet halfway on the purchase price and potential appraised value too. So
Right.
there's different ways to move forward from a short appraisal.
So those are, again, that's a reason why going into a property and making an offer, you would want to discuss with your mortgage professional, with your real estate agent, what happens if this property doesn't appraise, especially if you're going to offer above asking price, because the asking price is not just an arbitrary number, but as Christopher pointed out, it's usually supported by the values of other properties that are similar or in the neighborhood that have recently sold. And that's where the real estate agent says, okay, based on these comparable properties, how they compare to your home, this is what your home would probably fetch on the open market. This is what it would be worth to a buyer. Because it's really, when you say what's a home worth, well, it's worth what somebody will pay for it. So this is what it is as compared to a buyer. This is what else they may find. And this is why they may spend this much on your home. And when you offer above that, because again, we are still in a market where there is a lot of competition, you may be putting yourself in a position where you are offering more than the home is going to support in an appraised environment where it's been compared to other properties, because property prices are continuing to rise. Even though there were a lot of headlines talking about how things had slowed down, some markets, they haven't slowed down that much. So that conversation, you need to know what you have to work with, what would happen if it did come in less than what the value is, and then how you would handle that. And that's a conversation that you want to have directly with your mortgage pro, I say, for sure. As far as how I would have that conversation, I'm not an active originator anymore, but I did write loans for many, many years back when you were in high school. And the way that I would have that conversation again is that a home is worth what you're willing to pay for it. And somebody 2 years ago, if they spent $10,000 more than the appraised value, well, with home values going up over 2 years, now that would be $50,000 below the appraised value. So it's always an objective look at that number, and you've got to decide if that fits into your financial, wheelhouse, and if you're able to make that move, and if the house is going to be the right house for you, because it may make sense to buy over the appraised value sometimes, especially if you've looked for a long time and you as a consumer and the professionals on your team are comfortable that you're making a good purchase. Then that's there. But that's why I agree with you. It's a team concept, not only of just all the people that you mentioned, but even the consumer being part of that team and and understanding what they're looking for.
Yeah, and I would also add, like you were talking about from your origination standpoint, is working with your loan officer and real estate agent to really just be prepared and ask those questions. Don't be afraid to ask any and all questions. Always advocate for yourself. So when you're talking about offering on homes that might be over asking, have the hard conversations then, because it's way better than in the middle of a contract. So
Yeah.
understand your finances, know what you're comfortable with. Focus in on your short and long-term goals too. If you're paying $10,000 over asking on a property you're going to hold for 10, 20 years, might not be as big of a deal as if you're doing a 3-year stint.
Absolutely. So thank you for your comments, y'all. If you guys have any questions, please go ahead and put them on there. We're going to wrap up in a moment. We're going to do a quick summary, show you guys one more time kind of what we think is going to happen with rates. We'll give you a quick forecast on which direction things are going from here, and then we will wrap it up for today. So over the next couple of weeks, rates are likely to jump. They're likely to move higher if the labor data that we get this week shows strength in the job market. So that's your summary there. If we see strong labor data, we could see rates move higher. Now, it's not likely to be, when I call significant, I mean like a 0.5% higher, but we may see the move 1/8 of a point or a 1/4 point higher. So if you have a rate quote today of 7%, maybe it's 7.125 or what we call 7 1/8 or 7.25, 7 1/4. So be prepared for that. Over the next few weeks, rates are likely to creep higher and hold. We're not likely to see rates move down from here because in order to see rates move down, we would have to see some economic data showing the economy is slowing down and inflation is improving. Now, the caveat to this is that we do have a report coming next. See if I can get that to go by area. We do have a report coming in next week called the CPI inflation report. It's on July 12th. If that were to show that inflation is improving, that might help us a little bit, but we're not going to see rates drop significantly, even if we do get a good inflation report. Longer term, 3 months, 6 months from here, rates aren't likely to move much lower until we see signs of a true recession, meaning people are nervous about spending money. They're not spending money the way they are today. We need to see the economy slow down. So that's what we've got for you for this week for a rate forecast. Remember, you can join us next week. Christopher, is there anything you'd like to leave everybody with?
Happy house hunting. That's it.
There you go. Absolutely. So, and thank all for your service on the 4th of July as we just celebrated. I appreciate my freedoms and thank so many of you and the sacrifices that you have made as families and, giving up your loved ones and the loved ones that have been and participated in everything. So thank you all for that. We appreciate you. Remember, join us next week, same time, and we'll see you then. Take care, everybody.